Hi everyone, my name is Augustin from Siam Legal. It's good to be back here with you. In my previous video, I went over the answers to some specific tax questions from expats living in Thailand. Today, I'm back with the answers to some more specific tax questions that will help you understand more about the Thai tax system. If you're ready, let's have a look at the first question. I need to transfer a fund to the country for a visa application. Will I be taxed on that fund? The purpose of the transfer isn't relevant in determination of tax liability. The only issue that matters is what the source of the fund is. If the fund is income earned before 2024, then you won't be taxed on that income. However, if the fund is income earned from 1st of January 2024 and you are a resident of Thailand, then it is taxable unless the relevant tax treaty says otherwise. The second question of the day is, this year I've stayed in Thailand for more than 180 days. I've received rents from leasing my house in my home country. Will I have to pay tax on those rents? Rents are assessable income under Category 5. Since you derive them from property situated abroad, then you will have to pay tax if you bring them into the country. However, you can claim a standard deduction of 30% of the total income you earn, or a deduction on an actual basis if you can provide the Revenue Department with satisfactory evidence of proof of the expenses that incurred in connection with that lease. Also, you can claim tax credits under the DTA for any taxes paid in your home country against the tax payable in Thailand on those rents. The third question of the day. If I lease my condominium in Thailand during the year in which I'm not a resident of Thailand, do I understand it correctly that I won't have to pay tax on the rents I derive? Again, rents are assessable income under Category 5. As you derive them from property situated in Thailand, you will have to pay tax regardless of whether you're a resident of Thailand or not, and whether the rents are paid inside or outside the country. However, you are entitled to a standard deduction of 30% of the total rents you derive, or a deduction on an actual basis if you can provide the Revenue Department with satisfactory evidence of proof of the expenses which incurred in connection with the lease. The fourth question of the day is it true that a long-term resident visa holder is exempt from foreign-sourced income? Well, that depends on the type of LTR visa you are holding. If you are holding the wealthy global citizen, wealthy pensioner, or work from Thailand professional types, then the answer is yes. You are exempt from foreign-sourced income if it is remitted to the country. However, if you are holding the high-skilled professional type, you aren't qualified for that exemption. Instead, you are eligible for the 17% flat rate tax on income from employment of a company or juridical partnership in Thailand carrying on targeted industries. The fifth question of the day is, I'm working from Thailand for a foreign company. Will I be taxed on the income that I made? Income from employment abroad is assessable income under Category 1. If you derive it during the year in which you are a resident of Thailand and bring it into the country, then you will have to pay tax on that income. The sixth question is, this year, I've already become a resident of Thailand for tax purposes. I derived an item of income from another country and paid tax on that income in that country. This country has a double taxation agreement with Thailand. Do I understand correctly that I don't have to pay any tax in Thailand because I'm protected by the DTA? This understanding is misleading. Whether the item of income is taxable in Thailand depends on what the treaty says about that item of income. The mechanism of a tax treaty is to allocate the taxing right of types of income between the contracting countries. For some items of income, the treaty gives an exclusive taxing right to one contracting country. For other items of income, the treaty shares a taxing right between the two contracting countries. In the latter case, one contracting country, i.e. the country of residence, is required to provide reliefs for tax paid in the other contracting country. Thus, you need to check if the income is taxable only in the country of the payer of the income. If the answer is yes, then you don't have to pay any tax in Thailand. However, if the treaty says that the income is taxable in Thailand, then you will have to pay tax in Thailand, even though you've already paid tax in the other country. Even so, you can refund the tax you paid in the other country once you have paid tax in Thailand. However, if the treaty says that the income is taxable in both countries, then you have to pay tax in Thailand. You can claim tax credits for the tax you paid in the other country against tax payable in Thailand. All of these questions are answers to specific questions asked by expats living in Thailand. If you have questions regarding Thai taxation or would like to schedule an appointment with one of our tax consultants to determine your tax liabilities and how to legally minimize them, please check the information in the description below. Don't forget to like this video and subscribe to stay updated on the latest legal insights in Thailand. Thank you for watching, and we'll see you in the next video.